Welcome back and welcome. Today we're going to be talking about trading range. The last class we talked about the three kind of formation where we talked about the swing high, the swing low. So now we're going to be talking about the trading range and we see how what we call range cycle. So we feel the market structure in ranges, your higher high, your higher low, the basic market structure. So now range cycle help you to know where we are in the market and it will also help you to know the direction of the market. If the market is an uptrend or downtrend, is the trend changing anytime soon? That's why I call it range cycle. So it helps you to understand where we are in the market. The trading range consists of multiple different pieces that will eventually be blended all together to create it. So we're going to break it down into what I call the core element of a trading range. Now, if you remember, we've already talked about the QMs. So now, since we have two different move in the market, is that the market is an uptrend, bullish, or the market is in a downtrend. That's what the bearish. We have the bullish, we have the bullish, we have the bearish, and we have the ranging market. Bullish QMs. This QMs is what we call Quasimodo's QMs. Bearish QMs. Quasimodo. So now the first core element of a trading range are the bullish and the bearish QMs. The QMs are what frame the trading range and is how we confirm when a range is formed. They are very easy to understand since there are only two things that need to happen to identify them. Now to identify a bullish QMs, we need to see a stop on to the downside and a break of structure to the upside. And also to identify a bearish candle, you need to see a stop on to the upside and a break of structure to the downside. Now let me show you what this place is, what I'm trying to explain here. Now let's take for instance like this. Now the market moved this way. When you want to see a bullish claims, now the market move like this. Then the markets now move like this. You see that the next move here that we can see here, markets break structure downward. This is what we call stop on. Then market now break structure. Enough there. Now this is a stop on here. Because checking through this, pay attention to me. Checking through this is the previous low. And so many people already position themselves that they will buy the market here from this line. But then what do you see the market do? The market chank them, use them as liquidity, eat their stop loss because they replace their stop loss and yeah, eat their stop loss. The markets now move higher to come and break structure. Yeah, this is break of structure. Yeah, the break of structure to the upside. So we call this one a bullish what? A bullish QMs. This is a bullish QMs. A bullish what? Bullish QMs. Bullish QMs. Because this is our stop on. This is our a break of structure to the upside. Break of structure to the upside. This is a break of structure to the upside. That's your bullish QMs. Now the opposite of this is our what? A bearish what? A bearish QMs. Now let's go and look for something like this in the market. I will just look for an example. I'm not saying it's directly equal. Let me quickly talk about the bearish QMs also before we continue. Now your bearish QMs is going to be like this. Let me use my pads. Just pay attention. The market move like this. The market what? Come down. Market come like this. And market what? Shoot down like this. This is a bearish what? A bearish QMs. This is the previous high. This is the stop on market breaking structure to the what? To the market taking people's stop loss here. Then market now start moving downward. The market now what? Broke structure to the downside, confirming that market is now in a bearish. So market is now what? Bearish, because you already see confirmation through the break of structure to the downward, to the downside. So this explains what? The bullish and the what? And the bearish QMs. Now let's go check the market to see something like this as an example of what we've been explaining, so that we can be conversant with it. Now let's see where we can get a clear example of these things that we explain. I want to see a perfect example so that you'll be able to understand these things very well. Perfect example. You can use one as an example, but it's not a perfect example, because market was actually what? Respected. The market actually respected this. The market now come down to this place, to what? Let me help you draw a line so that you'll be able to understand what I'm trying to say very well. So now what do you see the market to here? And let me use this line. This is like the previous low, right? Market reacted it. Now what do you see the market do? The market is now what? Use this week a stop long and a stop point. Then market now what? Move up to break structure, confirming. This is a break of structure here to the upside. Let me use this now. There's a break of structure here. What do you see the break of structure? What do you see the market? The market reacted and come down a little, but not come down to this level. And the market starts shooting up to this side. Relax, shooting up to what? To around this side. You can see the bullish coins being from that side. Excuse me. Now this is a perfect example of a bearish coin. This is a previous high. Then stop on here. See the market go up a little. The market now was come down here. From here, let's see from here. What do you see here? Market broke structure downside. Confirming that the market is now in a downtrend. See the next move, the market rising, market started dropping. Even the one that come up to around that place that market was here, still respect this place. Automatically this become a strong high. A strong high. A strong high. So that's it. The bullish and the bearish claims. So I wanted to go through it and then leave your question for me in the comment section, and then we do justice to it. Thank you.